It's often said that the poor purchase liabilities. The middle class, they purchase liabilities under the impression that they're assets. And the wealthy, they purchase assets. Now, today we're going to go over 3 things that the wealthy purchase that makes them wealthier. And we've got one important bonus item that the wealthy purchase that makes them wealthier at the end of this video, so make sure you watch the whole thing. Now, let's get into what is a liability, these things that the poor and middle class typically purchase. A liability is something that is going to lose value and also maybe even end up costing you more than whatever the sticker price was in the beginning. So, for example, if something's not out there doing the job of an asset, and that job is appreciating in value, and or kicking off an income, then that thing is a liability. Now look, I'm not saying go through your whole life and only purchase assets. You've got to have some fun in life. This thing that we call life goes by pretty quickly, and we've got to enjoy it. So there may be some things that you want to go out there and purchase that do not fit the description of an asset. And as long as that's done judiciously, and you know what you're purchasing, then asset versus liability, then that's fine. So what's a liability? A car in most cases. Now, of course, if you have a business that rents cars or that uses a car to make money, or a motor-driven vehicle to make money delivering something, then of course, now that vehicle is a business asset. It is making you an income. So that's also with that, you can enjoy certain tax benefits when you have a motor-driven vehicle. If it depreciates, you can apply that to your taxes, so it works for you. But in most cases, when people go out here and buy a vehicle, that's a liability. It ends up not only costing them the sticker price of the vehicle, but also a finance charge. And did you know that most cars lose between 15 and 20% of their value in the very first year? Okay, so you are stuck with an obligation that on an item that is worth less than the obligation. That's a classic example of a liability. But you see a lot of people purchasing cars, going into big time debt. They're extending these loans out 6-7 years now on cars. And sometimes what will happen is people will purchase things. The middle class is typified by this. They'll purchase something like a boat maybe. And I want a boat, okay? I want a sailboat. I want to sail around the world, actually. That's one of my dreams. But I know that when I purchase that boat, it's going to be a liability. It's not an asset. Some people trick themselves into the belief that whatever they buy is going to appreciate in value. And a boat's not going to appreciate in value. If you doubt it, go on to one of these boat trader sites and check out the depreciation. You can do the same thing with cars. So we've defined liabilities. We've defined assets. Again, an asset is something that appreciates in value and or provides an income as well. So now let's get into the 3 things, and we're going to have a bonus at the end. The 3 things that people purchase, wealthy people purchase, that makes them wealthier. Number 1, education. Okay, now when I say education, please don't mistake that for necessarily a college education. Keep in mind, some of the wealthiest individuals in this world right now did not complete college. Bill Gates is one of them. So what I'm talking about with education is books, magazines, newspaper articles, seminars, various little, training courses and things like that can provide you with specialized knowledge over time. The wealthy are good at doing this. In fact, 85% of rich people read 2 or more self-improvement books per month. 94% of wealthy people read news publications daily. So, you see, this is something that you can't take away from someone. You can't take the knowledge away from them. And wealthy people, anybody really, if you consume enough information, you start to see patterns and you start to identify ways to make things happen. So if you're reading self-improvement books, if you're reading business periodicals and newspapers. Again, we suggested you get a subscription to the Wall Street Journal. We don't make any money off of it. We're just subscribers ourselves. No affiliations whatsoever other than that. However, I have noticed that How to Read the Wall Street Journal is the most watched video on this channel. So get a subscription, read it daily. You'll start to see patterns and be able to identify different ways to make money. Number 2, real estate. Real estate is a great way to build wealth. Not just wealth, but generational wealth. Most experts agree that you should be looking at a return anywhere from between 10 and 15%. In terms of appreciation on a real estate investment. You know, all things being equal, of course, we all know real estate's a hyper-local market and location is a big factor in that. But if managed properly, you should be seeing somewhere between 10 and 15% return. And don't forget, this is one of those assets, real estate, that allows the owner to control a large amount of the asset for a really small investment, comparatively speaking. That's called leverage. So, for example, you could control $100,000 worth of real estate for $20,000, or you could control $1 million worth of real estate for $200,000. You can't really do that with stocks unless you go and play the margin game, which we do not recommend. And there are a lot of ways to invest in real estate. You can invest in, again, commercial properties, residential properties. We just did the video about the changing face of the residential real estate investment market. You can purchase real estate investment trust. You can do a whole lot of things. Rental real estate. You can flip real estate, go in to a distressed property, improve it to market value, and then sell it for the difference. So there are a lot of different ways you can enter that market, and you can use leverage as a powerful tool, plus the tax benefits to help you get rich. A lot of rich people do that. That's why a lot of wealthy people, Sam Zell is one of them, are real estate moguls. Number 1, and then we've got our bonus tip. Number 1, paper assets. Now, what are these paper assets? Well, you might just say, hey, look, I know what a paper asset is. Stocks and bonds. And you would be 100% correct. But did you also know that insurance policies are also considered paper assets? And insurance policies, permanent life insurance policies that have been properly structured and properly managed, they can provide you with very important tax benefits in the same way that, real estate provides you with tax benefits. Insurance policies can do the same thing in slightly different ways, and they also appreciate in value. A large portion of insurance policies also have the benefit of being liquid, whereas if you want to get money out of your real estate, you have to either sell it, you have to refinance it, or in some cases, people will do things like take a reverse mortgage. So to get money out of your real estate, you have to rely on someone else to be on the other side of that deal. But stocks, paper investments, bonds, and insurance policies are pretty liquid assets that you can turn into money at the drop of a hat if you need to. Okay, here we are at the bonus tip. Dun, 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 dun. All right, what is it? What is that bonus thing that wealthy people go out there and buy that makes them more money? Businesses. Now, you might say, hey, wait a minute, you already talked about that when you talked about paper assets, you talked about stocks. Well, yes, stocks are an ownership interest in a business, but that ownership does not entitle you to any management interest. You can buy as many shares of Coca-Cola as you want, but you don't even want to go in there and tell them how to run the company because they've got institutional knowledge that you lack. So you just want to sit back, watch it appreciate, and kick off a dividend. When you go out and you buy an interest in a business, you're going to realize, if it's managed correctly, all things being equal, you're going to realize returns between 15 and 30%. So you might go out and open your own business or buy an interest in a business. That's how wealthy people get wealthy. They purchase businesses. Now, take Warren Buffett as an example. Warren Buffett owns Berkshire Hathaway. He's known as a great investor, and he is. But Warren Buffett also owns companies. Dairy Queen, he owns that. He owns a railroad. He owns Pampered Chef. He owns Geico. And people know him as an investor because Geico is an insurance company and they make money investing. All right, so that's how Warren Buffett has made his money, through business acquisition and business ownership. So there you have it. We've got 4 ways total that you can emulate wealthy people and buy those things that appreciate in value. You can go out, buy real estate. You can educate yourself. You can go out and you buy an interest in a business if you network and find partners that may be looking for that. And of course, you can buy paper assets all day long. Every time and any time you invest in anything, you must do your due diligence. The first rule of making money and investing is don't lose money. The second rule of making money and investing is never forget rule number 1. That's per Warren Buffett. All right, guys, I hope you found this helpful. Share it. I'll talk to you soon.